let's talk filing status. So filing status is important as well because it also helps determine tax rates. It helps to determine, remember the marginal tax rates that we looked at, that very first example was for married filing jointly filing status, which means each filing status has its own brackets. So we need to know filing status because our tax rates are going to be different based on what our income is, depending upon our filing status. A lot of our phase-out ranges for certain credits, the example that I just gave you with the child tax credit, are different depending upon what our filing status is. Also, our standard deduction, which you've already learned through your homework, is different depending upon what our filing status is. So it's very important to determine the proper filing status for an individual. Most cases it's pretty easy to determine, but there are some nuances in some of these, and you'll see as we go through. So we've got 5 different filing statuses: single, married filing jointly, married filing separately, so we've got 2 separate filing statuses for married individuals, head of household, and qualifying widow or widower with a dependent child. So we've got 2 filing statuses for individuals who are married, 3 filing statuses for individuals who are not married. Okay? First one is single. So this is an individual who, as of the last day of the year, is single. You could be married the entire year and get a divorce on December 30th. December 31st, you are single, you will file as single for the entire year. Okay, so it is all of these filing statuses with the exception of the qualifying widow or widower. It's got a little nuance to it. But all of them are determined as of the last day of the year, so whatever your status is on that day. There are other parts to the tax code where that is not the case. Like if you have a child during the year, you're considered to have had that child January 1st. Thank you. So you get the benefit, the tax benefit for the whole year if you had a child at any point, even if you had them December 31st. So you didn't have to pay for them that year, but you get the child tax credit and all of those benefits as of the first of the year. So this is for an individual who does not qualify as head of household or qualifying widower. Those 2 filing statuses are more tax beneficial than single filing status. The standard deduction for single filing status is the lowest standard deduction. The tax brackets for single filing status is the least beneficial. Okay, it's the least generous. So if you had a client who came in and said that they were single, you'd want to make sure that they don't qualify for head of household or qualifying widow or widower before you filed them as single. Because if they do qualify for one of those, it's more advantageous for them to do so. Okay, and we'll talk about those other ones as well. So this is one of those nuances I talked about. Individuals are also single if a divorce or separate maintenance decree was legally executed on or before December 31st. So I had mentioned the divorce aspect, but also if there's a separate maintenance decree, so the divorce isn't final, but one of the spouses has to provide some sort of support. Not like legal support, not just that they're giving them some money every month, but actual legal document. So that is one of those nuances. If there is a separate maintenance decree before December 31st, then that individual would file as single. All right, married filing jointly. Or any questions about single filing status? Okay. So remember, the answer to almost every tax question is it depends, right? So, am I single filing status? Well, it depends, right? It's going to depend on whether you qualify for one of those other filing statuses, if you have a divorce or if you have a separate maintenance agreement before the end of the year, that sort of thing. All right, so a couple that is legally married on the last day of the tax year can file a joint return that combines all income, deductions, and credits of both spouses. We already saw one of the, in chapter 1, we've got at least one problem where you've got individuals with two incomes that are combined. You have to add them together in order to determine the tax liability, right? So again, it's as of the last day of the year. So if you get married December 31st, it's as though you were married for the entire year. You get to file as married and get those more advantageous, usually more advantageous tax rates and credits and things for the entire year, okay? Marital status is determined under the laws of the state in which they reside. This really isn't, it's not as much of a big deal now as it was probably, 10 years ago? 10 years ago, same-sex marriage was not nationally recognized. It was on a state-by-state basis. So whether an individual was married or not was dependent upon the laws in the state in which they resided. Now that's not so much an issue. I can't really think of any differences off the top of my head in marital laws. Common law might be one. So in Iowa, you can be married under common law without there's no time limit to it. You don't actually have to have ceremony or all that stuff. If you hold yourself out as married, combine your income and act as though you're married, call each other spouse, then as far as Iowa is concerned, you're married. Other states are more stringent about that. Like maybe they'll say you have to have lived together for 7 years or something like that. So that might be one difference where common law comes into effect. By the way, if you're married under common law and you want to get divorced, you still have to get divorced legally. You still have to go through all of the legal stuff of getting divorced. You can just say you're married and be married, but you can't just say you're divorced and be divorced. If a spouse dies during the year, surviving taxpayer can still file a joint return. So this is where one of those exceptions to the last day of the year. So in the year that a spouse dies, that surviving spouse will still file as married filing jointly for the entire year. The following year, their marital status will change, and it will depend on whether or not they have a dependent child, what that filing status is going to be. All right, so a person who is legally separated from their spouse under a decree of divorce or separate maintenance decree is not considered married. However, couples in the process of obtaining a divorce that's not yet final can still file a joint return. It's just that usually in those cases, people probably aren't getting along. So it's a little difficult to do that sometimes. Non-resident aliens, if a spouse is a non-resident alien anytime during the year, that person cannot file a joint return. There's special rules with regard to non-resident aliens. We don't really get into it. It's rather complicated. There are people that will specialize in those types of tax returns for all the tax returns that they do. Okay, so that's married filing jointly. That's where you combine all of your income onto one tax return as a married couple. Married filing separately. This is where you are married, so you meet the same definitions under married filing jointly, but you are choosing to file separately for one reason or another. In most cases, it is not advantageous financially to do so. However, there are cases where couples may decide that that's the best thing. Oftentimes, in my practice, I would find the couples that did this maybe they were older and it was a second or third marriage. So they had kids, they had separate income, separate assets. They just want to keep everything separate. That might be one example. I had one client, a couple that was a client, and they wanted to qualify for some student loan repayment. There were programs that would allow lower student loan payments if you had certain income. But when they combined their income on a tax return, they were too high to qualify for those benefits. But when they separated them, they found that they were each eligible for those benefits, and so they chose to file separately. Also, some cases where you're not divorced yet, or I'm sorry, you're not divorced yet, but you're not getting along, and there's no separate maintenance agreement. Maybe you're not even speaking to your spouse, soon to be ex-spouse. So the relationship is just not at a point where both spouses want to file the same return, or maybe they don't want the other spouse to know what their income is, right? When you sign a tax return as a married couple, well, as any filing status, anybody who signs a tax return is signing under penalty of perjury, that all the information, to the best of their knowledge, is true and accurate. Well, if you know that your spouse is a tax cheat and is not reporting all of the income, you might not want to file together with them, because that makes you liable then for everything that's on that tax return. Right? Now, if you don't know, that's a different story. But there are cases, so usually these cases where individuals want to file separately, it's usually not a financial decision. It's a personal decision for them. But what they do is they each file their own separate tax return. When you do that, you do have to list the name and social security number of the other spouse, because the IRS will match those two returns up when they receive them to make sure that there wasn't a doubling up of certain deductions. There are limitations on what you can do if you're filing separately. If one spouse itemizes their deductions, both spouses have to. Even if one spouse doesn't have any itemized deductions, they may be forfeiting all of their deductions by filing as married filing separately. But they can't, and that's to prevent doubling up of the same deductions. As well as those phase-out ranges. You could get an unfair advantage if you were both able. If one of you was able to take the standard deduction and the other was able to take itemized deductions, you'd be getting an unfair advantage that you wouldn't get otherwise. Also, there are certain credits that you're not eligible for when you're married filing separately. We'll talk about all that stuff more, the itemized deduction part, in chapter 5. Okay, head of household. This is the one where everybody struggles. I was going to say students struggle the most. I struggle the most as well. So head of household, so much so that I'm going to write this down. Head of household. There are certain requirements for head of household. If you remember, if you can think of that tax return, page 1, remember there was a spot there for all of the standard deductions. On the bottom left corner of the page 1 of the 1040, they list what all the standard deductions are for single, the different filing statuses. Single was the lowest, married filing jointly was the highest, head of household was right in the middle. So for head of household, you are unmarried at the end of the year. Okay, so same as single, right? But you're unmarried. You have to be a U.S. citizen or resident. All year. You can't have become a citizen or resident during the year. You are not a qualifying widow or widower. You wouldn't want, if you were a qualifying widow or widower, you'd want that filing status anyway because you get more advantages than head of household. And this is the tricky part. You have to maintain a household that was the principal place of abode of a qualifying person for more than half of the year. Maintain a household for 6+ months for a qualifying individual. This 6 months is hard to remember because some of these you'll see, some of the things that we go through, sometimes it's 12 months, sometimes it's more than 6 months, less than 6 months. For this particular one, it has to be more than 6 months that you're maintaining a household for a qualifying individual. All right, so we're gonna have to define what a qualifying individual is, right? And we really need to kind of define what maintaining a household means, right? So To qualify as maintaining a household, taxpayer must pay for more than half of the cost of keeping up a home for the year. All right, so maintaining a household, pay for 50% plus of the household. Well, that means that somebody else could, if you're paying for 51%, somebody else could be paying for 49% of the cost of maintaining a household. And oftentimes this is what happens. You'll get multi-generational families living together, and there's a question of who is maintaining the household. So if you have like grandma and son and grandchild all living together, then it becomes complicated. Who's actually head of household? Because who is paying for more than 50% of the household? All right, they define here what is included in the cost. So rent, mortgage payments, real estate taxes, insurance, utilities, maintenance, repair, and food. Personal expenditures like clothing, medical costs, and transportation costs are not included in that. Okay? Whoops. I'm going to come back to this for a second. Now we want to talk about the definition of a qualifying person. Let's see. Did we talk about that here? I think we go through this. All right. There's a handy dandy little chart here that goes through who is a qualifying individual. So, you have to start with the relationship. How are you related to this person? How is the taxpayer related to this individual? If the person is your qualifying child, son, daughter, grandchild, who lived with you for more than half of the year and meets certain other tests, and there's some, we won't talk about that quite yet, and that child is single, or they're married but you can claim them as a dependent, then they are a qualifying person. If they are married and you can't claim them as a dependent, then they are not a qualifying person. If that person is a qualifying relative, we're going to go through what a qualifying child is and a qualifying relative when we talk about dependents. Okay? So this is the dependency definition of qualifying child or relative. If they're a qualifying relative and they're your dad or your mom, and you can claim them as your dependent, then they're a qualifying person. So you can be qualified head of household status, and the qualifying person is not a child, but an adult. It's possible for that to happen. If they're your mom or dad, and you can claim them as a dependent. If you can't claim them as a dependent, they're not a qualifying person. If they're a qualifying relative, but they're not your father or mother, and again, you'll see what qualifying relative is in the next section here. So grandparent, brother, or sister who meets other certain tests. Then it gets a little bit more specific. If they lived with you for more than half of the year and they're related to you in one of these ways, I'm not going to go click on that yet, and you can claim this as a dependent, then they're a qualifying person. You can see why head of household is the most difficult one. Go back. Go back. Go back. There we go. If they did not live with you for more than half of the year, they're not qualifying. If they aren't related to you in one of those ways, they're not qualifying. If you can't claim them as a dependent, they're not qualifying. So this is for a qualifying relative other than father or mother. They have to meet all three of these requirements. Okay, so for head of household status, again, unmarried, U.S. citizen, this is the taxpayer, U.S. citizen or resident all year. They're not a qualifying widower, and they have to maintain a household for more than 6 months, which means they're paying more than 50% of the household expenses for a qualifying individual. And these are the definitions of who a qualifying individual would be. Okay? Stop. necessarily, right? There are a lot of nuances to this. All right, qualifying widow or widower with a dependent child. Qualifying widow or widower has the same tax brackets, same standard deductions, same phase outs as married filing jointly. They're unmarried though. They are a widow or widower, which means that their spouse has passed away. And they have to have a child, a dependent child. So if you are, like, grandma loses her husband during the year, she doesn't have any dependent children, or dependents, doesn't have a dependent child, grandma doesn't qualify for qualifying widower status. That dependent child is required. So they'd be the same, kind of under the same classification as head of household, but if they qualify for this qualifying widower, it's going to be more advantageous for tax purposes. So who is a qualifying widower? The spouse dies during the tax year. The very first year, they're still married filing jointly. So if, dad dies, mom has 2 kids, they're dependent children. Dad dies on June 15th, 2024. In 2024, mom files as married filing jointly that year. Okay? But in 2025, mom gets to file as a qualifying widow with a dependent child. The following year, same thing. You get it for 2 years. After that point, mom would probably qualify as head of household. So you can only use this, now you can use it repeatedly, like if you keep getting married and keep passing away, you could keep using it. But for the sake of arguing what happens usually, that's not repeatedly, you can really only use it for those 2 years. Yeah?
Does this count qualifying relatives or only qualifying children?
Only a dependent child.
Okay.
So, and we'll define, so they have to be, I think they have to be under the age of, they have to be under the age of 19, or they have to be a full-time student. And then it's up to the age of 24 if they're a full-time student. So again, first year, the year that the spouse dies, they file as married filing jointly. The following 2 years, as long as they don't get remarried, they can file as qualifying widow or widower. Now, if they get remarried, they're going to file as married filing jointly, and you're getting the same benefits anyway. But they're allowed to do that as long as file in this status if they do not remarry before the end of those first 2 tax years. The taxpayer has to pay more than half of the cost of keeping up a household, so same requirements here. And the household has to be the principal place of abode for the entire year of both the taxpayer and a child, stepchild, or adopted child who can be claimed as a dependent by the taxpayer. So it is their child, stepchild, or adopted child. So it's not a relative, like it can't be your cousin. Even if you are supporting your cousin, then that cousin would not be considered a dependent child for the qualifying widow or widower filing status. They might be qualifying though under head of household, right? How are we doing? Do we need some Advil? It can be very confusing. Believe me, tax preparers struggle with this. We always have these like flow charts. If this, then yes, no, to try and figure it out, because it can be, because let's be honest, this is about human relationships. All of these filing statuses are about human relationships. Human relationships are complicated, right? They are not cut and dry. They don't fit neatly into boxes. So this also, as a result, this becomes complicated as well. Okay. Let's see. Filing status is also sometimes called surviving spouse. That's kind of less of a mouthful than qualifying widower or widower with a dependent child, right? And all of that stuff is So remember at the top of the form, oh, that's not here. At the top of the form is where we choose that filing status. For the vast majority of your problems throughout the semester, they're gonna give you the filing status. But in your chapter 2 homework, I think there are some where you're gonna have to figure out what that filing status is, okay? Questions. Refer to this is helpful, right? Now again, this is whether they're a dependent or not, we're gonna go over that here in the next section and what that means.